Hello, thank you for joining us today on our panel on the future of real estate. We've got a great panel of guests in a short amount of time to cover a lot of ground, so I'll just kick in with the first question. There's been such an incredible accumulation of wealth, and we've seen more and more of that increasingly being directed towards real estate. So Emily, I'll turn over the first question to you. How has this wealth boom impacted the world of real estate and real estate investing?
Thanks, Natalie. I'm actually excited to answer that question, mostly because for CIM, we've experienced it as it's really shifted from the defined benefit plans and moving into the hands of individual investors. Luckily, we have built from the beginning something that is our community-based approach, where we're able to offer a really wide range of assets and asset classes to the individual investors, but we're really seeing that they want to take control, they want to understand, and they know that real estate is a very important piece of their portfolio. We now just have to find the ways to actually deliver that to them in a way that they can invest individually.
Ryan, what have you seen on your end in terms of this demand from individual investors for real estate, and what opportunities does this provide for firms like yours?
Yeah, so we're pretty well aware that real estate is one of, if not the most important asset class to own to build long-term wealth. We're also aware, and I'm personally aware, which is why I founded the business, of how inaccessible it is for the vast majority of people. And so Cadre's mission is ultimately about democratizing access to real estate. It's leveling the playing field between institutions and individuals. And we don't want a repeat of what we saw happen after 08-09. When there was a huge influx of wealth created, but for a relatively small part of our global economy, for the largest institutions. And so what we're doing is making real estate more accessible through technology. We're letting people invest in high-quality institutional-grade real estate at lower minimums with greater transparency so they can see what they own, and with liquidity. We built the industry's first secondary market to give them financial flexibility. And we actually launched a product, the Cadre Direct Access Fund, that was focused on asset classes and sectors we thought would be especially resilient coming out of the pandemic. We're proud that we've enabled thousands of individuals to be able to actually invest in those same asset classes and hopefully benefit from the recovery in a way they weren't able to in 08 and 09.
Perfect. Michael, we spoke on the phone last week, and you mentioned that individual investors are increasingly looking for more illiquid opportunities in the market. Why is that?
Well, I think intermediaries, whether they're broker-dealers or RIAs or investment managers providing advice from sound portfolio management theory, seeing the information and relationship advantages of illiquid assets, to the extent that you can withstand the illiquidity, they're increasing the overall exposure in their portfolios beyond public securities. And so the advice they're receiving from their financial advisors is to increase their exposure to illiquid alternatives. That just trails institutional investors that have been pursuing this for a number of years. It also gives these same firms an ability to differentiate themselves versus the products being sold in the public securities markets. And ultimately, the economics of these illiquid alternatives offerings are more advantageous for most of those intermediaries. I think all those forces are at work driving the growth of this sector.
We've seen incredible competition and capital building up on the sidelines, whether it's from private equity firms, debt funds, or individual high net worth investors over the past 2 years looking for real estate investment opportunities. What types of assets are individual high net worth investors looking at that's more attractive compared to institutional investors?
Yeah, well, I can talk about from what we've seen at Cadre. And what I would say is that the number one focus, a lot of the individual investors, and we've got nearly 40,000 individual investors on our platform, is yield. Now, yield's really challenging to find today. And so what we like to do is help individual investors understand why it's important to also have a balance of growth and value alongside that yield. That's why we launched a portfolio offering as the first offering that would be more widely accessible for individuals to invest a few $1,000s per property at the end of the day. And so what we've focused on is diversification, because in a world where you don't give that kind of insight, people tend to look at the biggest number, the greatest headline IRR or yield threshold without properly assessing the risk. And over time, what we've been able to do is help people understand that there is a place for risk, there's a place for yield, and have a true institutional type portfolio. So yield is what everyone's looking for. That's not what the market's necessarily delivering today. And instead, we've shown folks that real estate on a diversified portfolio basis can be a great hedge against inflation, and tried to focus investors, individuals, in that theme versus trying to promise them the world.
Are there specific assets or geographies where investors are more drawn towards these days?
Well, I was actually going to add real quick, if you don't mind. I don't think there's a difference in what our high net worth individuals are looking for in terms of a stable real estate investment from what we're providing to the institutions. And at CIM, what's really important to us, the platform that we built based on a community-focused type investing, and then our vertical integration, has allowed us, and other managers have similar advantages, but really allowed us to go across the risk-return spectrum. Individual investors coming in want to have the same opportunities. They don't want to be secondary to the institutions. And now what we're looking to do is build the vehicles for them to be able to come in right alongside. And it's a very natural transition from our business, something that we've been doing the whole time, and continuing with that vertical integration to have a great view from basically birth to disposition of an asset to be able to offer it all. And I think it's important that the individual investor feels that same ability to access it as the institutions.
My add, and I'll go on sectors. I do think there's been an explosion of demand for both yield and liquidity if you look at the non-traded REIT market and how it's exploded in the past couple of years. So I do think there's demand, and that would be distinguished from some of the institutionals. In terms of asset classes or sectors, I've never seen the boat so tilted in my career. The market is industrial, multifamily, and some of the specialty sectors, and that's where the fund flows are. That's true institutional, and that's true individual. Now, that doesn't mean there isn't a bid for or interest in other asset classes such as office or retail, but if you really look at the fund flows data, that's where the fund flows are, because that's where growth is. And investors are pursuing growth, and the secular fundamentals underneath industrial and multifamily are compelling.
Well, let's dive into that a little bit, because everyone's going towards apartment rental buildings and industrial with the growth of e-commerce. So where do you find the most attractive opportunities out there to compete against, the likes of Blackstone, Prologis, the big institutional investors that are all scooping up these types of assets as well?
Yeah, I'm happy to jump in.
Yeah.
Look, I think real estate's a massive industry. It's not necessarily a winner-take-all industry. And just like, in the stock market and the equities, I think the beauty of it being such a big industry is there's always micro opportunities within that macro environment. If you find the right management team, you find the right operating partner, you can outperform the market. I look at what Michael and Krol have done in industrial, and they're an incredible example of amazing management that's been able to differentiate themselves and the exact types of partners that we get excited about offering up to individual investors. And so we focus, as Michael mentioned, on multi-industrial, life sciences, but we're overlaying that with geography as well. One of the novel things that we've been able to do at Cadre is develop a data science-driven model for market selection. Now, I'm not saying that robots are picking which markets we're investing in, because that's where I think people get carried away. I am saying that we've built a model, including the Cadre Property Price Index over the last 7 years, that's helped guide our investments team as to where there's growth, where there's appreciation, where there's affordability. And so when you overlay the asset class with some of these markets, then I think you can find real unique value and opportunity. And they might be markets that are less liquid. We recently looked at a deal in a big college town in Michigan that otherwise we wouldn't have looked at if we hadn't recognized there was unique affordability and unique growth in that market and that sector. And we like to, again, overlay those two dynamics to find opportunity when things are hyper-competitive and where there is a lot of capital on the sidelines. I think that's the winning formula that we've been able to employ so far.
Got it.
When you have that competition as well, I think it requires a piece of creativity in the other asset classes. And so in our approach and in being boots on the ground in every single community where we're investing, you can look at something like retail, which most everybody at this point would, you're like, oh, I'm going to stay away from that. But how can we take a creative look at it, and based on the community where we're at, maybe they're in need of some creative office. Maybe they're in need of a multifunctional type of space where we can bring down some of the retail exposure and convert to something like multifamily. There's opportunities, but a lot of it is really understanding the communities that you're in and having the ability to, it's not just the third-party data, it's your boots on the ground data that's really going to allow you to make some smart purchases and opportunities, regardless if one sector is hot or the other. You can still really balance it out.
The business remains, notwithstanding the data scientists, it's a relationship business. Getting the benefit of the doubt, getting the first call, getting the last look. The business is intermediated by people. And doing what you said you're going to do and having boots on the ground and relationships built over time, that's the edge. There's no secret sauce in the business. That's the edge. And you earn that by doing what you're going to say over time. And the largest asset managers are terrific, but they're going to chase multi-billion-dollar portfolios. It's a massive asset class. It is highly fragmented. It is highly local. There's opportunity for small mom and pops, and there's opportunity for trillion-dollar asset managers.
That's the conversation Michael and I were just having before we came out here. It's about building the relationship, especially as you move into the high net worth space.
Right. Well, we talked about what assets people are attracted to, apartments, industrial. What are some contrarian bets that these individual investors are looking at and that you guys are looking at as well? Emily, do you want to start?
Yeah, sure. We're big on debt right now. So we've seen, again, through having the relationships, and experiencing real estate through acquisition, our own underwriting, we are very comfortable taking on the construction debt space. Banks tend to shy away from it. It's a complicated underwriting. You have to know what you're doing. You have to know the value of the end property. And most importantly, you have to be able to understand the pitfalls that you can fall into along the way. Falling short on timeline, over budget, all of those things that have caused an increase in the rates, which means we can get some great returns on it, but it's actually a very good, stable investment. Something that's difficult or more difficult for an individual investor to come into on their own, but through an asset manager that can do it well, it's been a fantastic conversation point for us, and we've shown great returns and work through that over the years. Michael, Ryan?
Most of what we're pursuing is growth. There is one area, and you mentioned earlier, retail is in the midst of major change and disruption due to e-commerce and other forces, and fund flows to retail is pretty poor. But to your point earlier, not all retail is the same. And so in the communities you live in, I guarantee you there are these boxes. They have 6 tenants, they're 20 feet wide, maybe 60 feet deep, and they're all food and service. They're your Starbucks on one end, and your Jersey Mike's on the other, and your cupcake store, and your dry cleaner, and there are tens of thousands of them in the United States. And there's very limited fund flows to retail real estate today. And those boxes are not getting disrupted by the internet. And in fact, during COVID, those boxes did particularly well. Where did you buy all your food from on those apps? And so we're trying to swim where the capital markets may not be swimming, and that is the one area that we've identified and been executing on. And I still think it's a great opportunity and will be for some time, because you keep reading about the negative news about retail, and that helps. So,
creative office as well. It's another one that lands in there. We may be moving out of the high-rise office space we're all experiencing in New York. But creative office, if you're talking about studio space, podcasts, which we're all used to and doing now, needs space. And so again, if you can get creative with it, there's some real opportunity there.
Well, we talked about the importance of geographic locations and certain investments. Prior to the pandemic, everyone was looking at major metropolitan cities, New York, San Francisco, LA, and we've seen an increasing move towards more secondary markets. Ryan, I'd love to hear your thoughts on this. You're a New Yorker. What are your thoughts on investing in New York City? Are there any other markets that you guys are more bullish on?
Yeah, so I would actually say we pre-pandemic were not investing in the big cities, the big markets, largely because we couldn't really justify a lot of the valuations or cap rates. We like to think that we were focusing on some of the quote-unquote secondary cities that have now been primary before they were hot. So markets like Phoenix and Nashville and Savannah and Atlanta and Dallas and Tampa, that, if you looked at our portfolio pre-pandemic, was the vast majority of what we owned. And then in terms of asset classes, we didn't really own anything in CBD, big office at all. And so we actually indexed more to suburban office. We thought there was a unique opportunity in terms of just a cap rate spread and buying something in Greenwich, Connecticut versus in downtown New York. And we've actually seen those suburban office assets perform incredibly well. So now the question is, okay, well, what are the next, kind of Cadre 15? What are the next markets that we think are currently being considered secondary? To your point, some of the previous primary markets actually are starting to fall in that box because of affordability. So New York actually is one of the markets that we have been increasingly looking at from an investing perspective, largely because the affordability in many pockets of New York has actually increased, given you've had a lot of people move out to the suburbs and stay put. And so we're bullish on New York. I'd never bet against New York. I think though there is an element of asset class selection that has to be right on top of the money in order to really excel, because it is hyper competitive market. I think there's a lot of unique cultural dynamics associated with New York. And I think there are a lot of other cities that will rebound, will take some time, and where there could be opportunities, again, on a micro level to snatch up investments. But we spend the majority of our time actually focused on markets that a lot of people are not talking about, that we think will be that next, Cadre 15, where there will be liquidity flowing in, 3-5 years from now, where there's, millennial inflow coming out of the pandemic, where there's proximity to academic institutions, where there's geospatial and mobility data that gives our team conviction that this will be an area that will continue to see population density, and where there's relative affordability and city governments that are business friendly as well. So that's kind of the strategy for us, is not big cities, but that next Cadre 15 that hopefully a few years from now people will say is now a primary market as well.
I think there's a macro view and a micro view. The macro view is one simple rule to invest in real estate is invest in real estate where people are moving to. And so people are moving to the southeast and the southwest from the northeast and Midwest, and those trends are clear and have been clear for years, and that secular trend is not slowing down. That secular trend is increasing. But within that, some examples, there are other places in the country where you don't have that growth, such as the Chicago area, where the distribution infrastructure is so unique that industrial in Chicago is a massive market, and there are opportunities in that. But as a general rule, we are investing in those markets where people are moving to. Now, our company is headquartered in Dallas, Texas. We do have offices, 20 offices across the country. So the places where people are moving to the country is our neighborhood, and those are the markets that we're largely investing in.
So in this environment of market volatility, lots of things happening in the macro environment, what are the biggest risks that you see nowadays for investors? Emily?
I'm going to go back to the debt side of it, actually. We haven't seen a lot of the distress in the way that we thought we were going to. I think when COVID hit, at CIM, like many managers, there was a sense of, okay, where are we going to have to try to pick up some different pieces? And we really didn't. There was a blip, but we didn't experience it, I don't think, to the level that most of us expected. Where we're anticipating now, and as we're connecting with our communities, is really on some of the different, particularly the retail, office, and some hotels, of they got some relief on their lending going when COVID first happened, and now that's starting to wear off, and we're in an inflationary period. We're also at a point where they haven't been able to get occupancies back up, and it's in a lot of the city centers or the industries that we mentioned, where they're really going to just struggle, and now they have to refinance, and I think we're going to see some distress in those areas. The thing is that retail, not too long ago, was actually a go-to as a consistent income flow on long-term leases, and that's going to start to see a little bit of a challenge as well. So adapting to it, listening to what we see potentially coming down the road, and then making it an available investment as well.
Michael?
A myriad of risks, but the reality of what's occurring right now is we've got inflation, rising interest rates, and you're starting to see real time the impact on the cost of credit and the availability of credit, particularly as it relates to the office sector. It's happening real time. And so it's math. And particularly if you have sectors that aren't benefiting from inflation. So if you have an apartment building, you're rolling the leases over every month, you're picking up the benefits of rental growth, you're able to absorb these rising credit costs. But if you have buildings that have long-term leases in them, or you're concerned about the ability to release it, that cost of credit is not being absorbed in your rental income. And so those assets and those sectors that cannot absorb it are going to hurt. And right now, as we speak, the office sector is getting impacted. And the reality is you're seeing 10 to 20% deltas in pricing in the past few months. You're seeing deals being pulled. And even in sectors that have growth, like the multifamily sector, pricing is at the margin. People didn't expect this new cost of credit, and you're actually seeing some small retrades. Now, that's not going to turn into distress, but nonetheless, it's this inflation and cost of credit. We run a levered industry, basically, and so the availability and cost of credit, and it's happening real time. And I don't know what the future will hold, because none of us do.
Given all this risk, what assets or investments are best protected against this inflationary background?
Well, I mean, talk about what we focus on, multifamily. People are always going to need somewhere to live. And, the reality is there's some other macro trends as well that exist that have made multifamily and industrial especially attractive as an interesting hedge. You think about supply chain issues we have, and there's a lot of concern about supply chain and building and development. It's actually acted in a pretty interesting way. It's muted a lot of new supply in some of the markets on the multifamily side that we invest in. And so as a result, we've seen renewals at our multifamily properties stay at all-time highs in terms of people signing up new leases. That also is amplified by the fact that it's hard to buy new homes, and the pricing of homes is frankly astronomical and almost antithetical to the American dream. And so we like multifamily, of course, because of the fact that it provides a pretty consistent cash flow yield profile for our investors. I think it's relatively countercyclical. And I think on the debt side, financing you can get in some cases actually becomes the asset itself, given where rates are in that space. So that's where we spent the bulk of our time to date. I think there's a lot of macro trends that will sustain that as well.
Perfect. We spoke a lot about how real estate is a lot about interpersonal relationships. When you think real estate, you think physical buildings, physical assets. I'd love to talk a little bit more about the impact of technology on real estate and real estate investing. I mean, traditionally, real estate has been a bit slower to invest in prop tech and pick up technology. Emily, how are you guys looking at the use of technology in real estate investing?
Yeah. I'll be the first to say I'm not the expert on prop tech. So, but where I think it's important as it pertains to the high net worth industry and moving into that investing space, what we've seen is a high demand of making sure that you are providing accurate, obviously, and timely information on what they are invested in, why they're in it, when there's news that there's responses. So I think you'll see a lot of managers from just a technology standpoint on media and information flow increasing, and then making it easy for them to be able to come into your funds. I think Ryan's has quite the network built there, being able to come in and subscribe. But we're going to have to constantly be keeping up with what our investors are looking for.
Technology's been impacting real estate my whole career. I mean, first of all, it's created sectors that didn't exist. Data centers, biotech creating life sciences, towers due to cell phones. And so you've had the creation of real estate asset classes. You've seen information management, the ability to get information on fundamental supply and demand dynamics in a given market through a multitude of forces. Your HVAC and energy systems that now you can control, building materials that have improved, capital markets tools that allow various market participants, auctions, And so this is a mosaic. There's been a ton of money that's fled out of the VC world in the past 5 years as the last vertical. I think it's great because we all benefit from all that capital. But there are areas that fundamentally the technology industry has overstated its ability to impact. And two of them are very obvious. It was in the 1990s that we were going to disrupt the residential real estate brokerage industry, right? Everybody was going to do that. Everybody in this room, when they sell a house, probably hires a broker and pays 5.5 points. What we did was give the residential real estate brokerage industry better tools. There are numerous examples of construction technology failures that have gone on. One of the businesses we run is a large construction development business. I assure you, it takes human beings to build buildings, and there are people working on robots building buildings. So I think that there are things that have been successful and really impactful and changed the course of events. I think things have been, there's been hyperbole around other things, but I think it's wonderful, and I love to see this capital come to the business because it just makes the real estate business better for all of us.
Yeah, well, clearly I started Cadre now almost 8 years ago when the prop tech terminology was laughed at, and when the idea that technology could have any impact on how the real estate investment world operated was laughed at by a lot of big institutions, now many of whom are espousing technology and talking about their prop tech business arms. So that's exciting for me to see everything come full circle like that. In terms of technology, though, look, technology can really do two things. It can create destruction, or it can create creation, can rebuild and reassemble. And I think what it's doing in real estate is the latter. I think we're seeing right before our eyes the fundamental change of who can access what has been a closed network for so long as a result of technology. It's recreating how investors are able to participate in the asset class. And again, we're proud that we're a small part of the democratization and the opening up of the asset class. There's many others as well. It's changing how operators and developers raise capital for projects. We'd like to think that what we've been able to do is provide a more flexible capital source. It's changing how people who actually own real estate function and operate in the interim by giving liquidity, which is something that hasn't existed for individuals. So I'm incredibly excited about how technology will transform real estate for the better by leveling the playing field for all market participants. At the same time, there has to be an acknowledgement that relationships are critical in the space. And that's what we've tried to do at Cadre, is bring folks like Mike Fascitelli, who chairs our IC, alongside engineers from Google and Facebook under one umbrella, because there has to be parity. And that's where I think people have got things wrong, is when they index too much towards the real estate or the technology to try to build something that's novel and innovative. And it's together that we see the kind of magic that platforms like ours are looking to create.
We've only got about a minute left, and I'd love to end this panel with a question about the Metaverse. We've obviously seen so many banks get into this. JP Morgan called it $1 trillion market opportunity. Real estate seems like it would have a natural place in this virtual world. So I'd love to hear what your thoughts are on the Metaverse, what the opportunities are. Ryan, go for it.
Yeah, I think similar to frankly just crypto, there's a lot of terminology that gets thrown around, and there's not a lot of fundamental understanding. I think we all can agree that there is way more virtual engagement, just generally, right, in terms of how people are interacting with each other, how they're engaging, even in the transaction world as well. I still think that there's not enough guardrails around things like the Metaverse and Web3 and the like for it to be something that is really going to change and move the needle, from an investor's perspective as to whether or not they should be jumping into this space. But I believe in decentralization. I believe in opening and democratization of access. And I think it is a matter of time before the Metaverse does become something that is more practical, tangible, and value add. But we're still ways off, just like I think we're ways off from blockchain reinventing who can invest in real estate and who can't.